Are you wondering how to practically use the discounted cash flow and economic profit frameworks? In this video, we will look at how to simplify the economic profit approach using perpetuities. The key difficulty to using the discounted cash flow and economic profit approaches in practice is the need to prepare detailed forecasts of aspects of a firm including profitability, growth, and the cost of capital for several years, say 3 to 5 years, and then have a simplifying assumption with a continuing value. We will focus on the economic profit approach, but the same sort of issues would apply to the discounted cash flow approach. One way to simplify the economic profit approach is to say it is not possible to forecast a firm's abnormal operating income. Impossible. In other words, our forecast horizon is not a few years into the future, but right now. Where we have no idea how to forecast a firm's abnormal operating income, our best guess about our firm's expected future abnormal operating income would be its current abnormal operating income. This could be expressed as forecast abnormal operating income in year 1 equals abnormal operating income today. Also, forecast abnormal operating income in year 2 equals forecast abnormal operating income in year 1, and so on. This is another way of saying that the current economic and business drivers of a firm's abnormal operating income are expected to continue as they are forever, and that any future changes to these economic and business drivers are completely unpredictable. In this case, our forecast of abnormal operating income for all periods into the future, that is to eternity, would be current abnormal operating income. Such an approach greatly simplifies our economic profit model, since the present value of abnormal operating income would simply be a perpetuity. Our economic profit model is the value of equity equals the current book value of equity plus the present value of abnormal operating income. And so our value of equity would be the book value of equity plus current abnormal operating income divided by the weighted average cost of capital, the cost of capital for operations. This is a perpetuity, which is the present value of a constant stream of identical amounts of abnormal operating income for eternity. We could also include growth, for example by a constant growth rate each year, such as 4%. If we were to assume a constant growth rate in abnormal operating income, we could express our economic profit model as value of equity equals the current book value of equity plus current abnormal operating income times 1 plus the growth rate G, divided by the cost of capital for operations minus the growth rate. We still need to assess the cost of capital for our firm, the weighted average cost of capital. This is difficult to calculate. This can be alleviated by carrying out some sensitivity analysis of our firm's cost of capital. See the Study Guide Chapter 8, Section 8.3 for how we apply this simplified economic profit model to value Ryman Healthcare. Also review the Going Forward weekly questions. Also answer, write and rate questions in Peerwise.